Hey, I'm Cody Charnell, and this is episode 4 of the How to Analyze a Rental Property series. In this series, we do a deep dive into recently closed multifamily properties located in Long Beach and surrounding areas. And the goal of the series is really to give you practice running through the numbers, get you familiar with the real estate market, and hopefully get you closer to your goal of building up a portfolio of rental real estate. Today, we're going to be checking out an 8-unit building that recently sold here in the city of Long Beach. The video is broken up into 3 sections, so we'll look at location, property details, and the numbers at the end, and you can use the chapters down below to skip around. If you get any value out of this video, please remember to like and subscribe, and without further ado, let's get into it. So the property we're looking at today is located at 1621 East 5th Street, and it's in a neighborhood called North Alamitos Beach, which you can see on the map here. This neighborhood has a lot going for it. Not only are you just 5 blocks to the ocean, but you're also bordered on one side by the East Village Arts District in downtown Long Beach, and which has a lot of new development. That section of town has gotten really nice. And then going to the east, you have Rose Park and Carroll Park, which are nice historical districts. And basically, when you're in this section of Alamitos Beach, the closer you get to the ocean, the nicer it gets. The main street that kind of breaks through this neighborhood is 4th Street. And for whatever reason, this section of 4th Street has kind of lagged behind, and it's taken longer to get nice. When you go just east of Cherry, you have this section, the 4th Street corridor. This is called Retro Row, so lots of trendy restaurants, bars, and shops kind of right in this area. And then as you go into downtown, just west of Alamitos here, this section of 4th Street is also really nice. You have newer development projects with luxury apartments and lots of kind of trendy shops and entertainment here as well. If you were to drive down this section of 4th Street between Cherry and Alamitos 10 years ago, it was primarily made up of dive bars and corner stores, but a lot of those businesses have started to change hands. So now we see like vegan restaurants popping up. We've seen some of the bars change hands and go from dive bars to a little bit more upscale type of bar. We've also seen new businesses moving in and even redevelopments of some older commercial storefronts. So I think if this trend continues over the long run, it's going to be great for rents and property values in this neighborhood. The neighborhood is primarily going to be multifamily. So it is a dense neighborhood, as you can see, kind of looking at it here on satellite view. If we look at the census map, basically, North Alamitos Beach is this section here. So the census map is showing the dark areas are primarily going to be renter neighborhoods. So, this neighborhood is definitely a high concentration of renters. So in the 1970s, the city of Long Beach changed its zoning rules and started to allow high density apartments to be built on residential lots. It's really easy to identify 1970s and 80s construction because it'll always basically look like this, where there's parking on the first floor and then 2 stories of apartments above. But with that, let's take a look at some property details. So this is the MLS listing for this property. Just a little disclaimer, I was not involved in this transaction. I just thought it was a great deal, which is why I'm making this video, but congrats to the agents who were able to put this one together. Looking at the listing, you can see asking price for this property was originally 2.5. They ended up selling at 2.448. It's 8 units built in 1986, and the unit mix is going to be all 2-bed, 2-bath units. And configuration of this building is just like all the other 1980s buildings, with parking on the first floor and 2 stories of apartments upstairs. The upstairs units are going to have vaulted ceilings, which is pretty common in 1980s buildings like this. And if we scroll down, you can get a sense of the rents. Right now, 2 of the units are rented out for $2,008. That's kind of your lowest end. And then on the highest end, you have a unit rented out for $22.23 a month. I think there's upside in all of these rents. I think market rent for these units is probably $23.95 up to $25.95, depending on how nice you make them. And if we look at the photos, you can get a sense of the condition. So it looks like the units have been pretty well maintained, probably upgraded at some point in the past, but it doesn't look like they've been touched recently. So that sort of makes sense when you think about where the rents are. So a new owner could go in and put more modern finishes, newer cabinets, and get a bit more rent out of these. And you can see common area laundry. So you do have coin-operated laundry machines, and you can see parking. So One big bonus with this building, because it was built in the 80s, you're not going to have to worry about seismic upgrades. So 1980s buildings meet current seismic retrofit standards. Some other cities, like City of LA, has passed a seismic retrofit ordinance. So any building built before 1978, they oftentimes will require owners to seismically retrofit buildings that have tuck under parking like this. Long Beach is actually in the process of passing a retrofit ordinance. I've done another video about that if you want to check it out, but because this one's built in the 80s, you don't have to worry about that. Another big benefit of 1980s construction is, builders were using copper plumbing and more modern electric systems, so you're not going to have issues with insurance like you will on some earlier properties if they have older electric systems or older plumbing. But with that, let's take a look at the numbers. So now we're looking at my pro forma for this deal. You can see in this section we have property details like price, square footage, and a few estimates for expenses. Down at the bottom we have the unit mix and rents. So this is our current rent and this is market rent. I'm estimating $23.95 as market rent for these units. And down at the bottom we have a section for extra income. So there is a common area laundry room. I think in order to hit these rents, you're probably going to need to install in-unit laundry. So that would make the common area laundry room kind of obsolete. You may still be able to convert it into just storage and rent that out to one of the tenants, but we'll leave income for the laundry room blank for now. Because this is a 5-unit and up deal, you're going to need to get a commercial loan. And in other videos, I've talked about how commercial loans work, but basically lenders will look at the property like it's a business and they force you to put enough down so that the business is cash flowing from day one. And the metric that they want you to hit is here. So the banks right now are requiring a 1.25 debt coverage ratio. And basically what this is saying is the property is generating $1.25 of net income for every $1 of mortgage expense. So with a 1.25 debt coverage ratio, you're going to be cash flowing. Interest rates on commercial loans are around 6.35%, and it looks like with my estimates for expenses, you're going to need around 42% down to make financing work on this one. If we go over to the summary tab, you can see the metrics for this deal. So I focus a lot on gross rent multiplier, so this one's priced at 12.32 times gross based on current rents, and you can get the building to operate at 10.65 times gross if you're able to get those rents up to market. And you could see our proposed financing here, so monthly payment and all of our operating expenses, and these are just my estimates. And then in this section, it shows our annual operating forecast. So basically, we have our gross rents for the year, less a vacancy expense, less our operating expenses, which come from this section, and then less our annual debt service, and that spits out our cash flow. So right out of the gate, you're going to be cash flowing around 26 grand a year. And you can almost double that by getting rents up to market, which is really good. And then down at the bottom, this shows our combined elements of return. So if we just estimate 5% appreciation on this deal, you're making 122 grand from appreciation. We also have our cash flow, which is based on the market rents there. You get to depreciate the value of the improvements. And you also have equity buildup through amortization, which is a fancy way of saying you're paying down your loan. So in the first year, with these conservative estimates, you're looking at about 19% return. All right, so now looking at our comp summary for this deal, I chose 3 1980s buildings to compare this to, which all have sold within the last 6 months. The first one is a little bit further north, so further away from the beach than our subject property. Also 8 units, almost 2,000 more square feet, so bigger building. This one sold for $2.65 million, and it was priced at 13.4 times gross based on current income. So a higher gross rent multiplier means less rent relative to the sale price. So with this first property, the buyer would have had to come in with a bigger down payment. And based on market rents, this one is operating at 11.27 times gross, which is higher than our subject property. So not as much upside on this one as our subject. The second one is in the same neighborhood. This is a 9-unit building. Bigger square footage as well. This one sold for $2.35 million. It sold at a little bit higher GRM, but it also had more upside. So I think this deal would have been a little bit better if all else is the same, just because you can get it to stabilize at a lower GRM than our subject. So it's more of a value add deal. You're also buying at a lower price. And the last one is a little bit nicer location. So this one's going to be south of 4th Street, really close to the beach. Also 8 units, quite a bit more square footage. Sold for $2.7 million, which is a 14.1 GRM based on current rents. So definitely going to need to come in with a much bigger down payment. And once you get it up to market rents, it'll operate at 11.5 times gross, which is higher than our subject property, but nicer locations do tend to trade at higher GRMs. So this one looks like a pretty solid deal as well. Looking at our subject property, you can see gross rent multipliers on current and market rents. And I think the one metric that stands out compared to these three is the price per foot. So because our property is smaller, it is trading at a higher price per foot, but I think looking at it on an income basis, I think we're still doing pretty well because we're right in line or even slightly better than a couple of these other properties on gross rent multiplier. So I'd love to hear what you think about this deal. Please leave your thoughts in the comments below. And if you got any value out of this video, please remember to like and subscribe. I'm trying to put out one of these videos per week. So if there are any properties that you'd like me to do a similar analysis on, I'd love if you'd send them my way. And lastly, remember, invest well, trust Cody Charnell.